Thanks for joining us. I'm Paul Sponcia. I'm the CEO of the IT company. Of the group on this call today, I am simply here to be the moderator. So I'm not the expert. I'm just the moderator. So this is our fourth, maybe our third actual webinar. And then Chris and I did a video as well on this. And really what we've tried to do is just provide some input from some of the people that I know who understand this category on just what's going on with this small business loan, grant, whatever we're going to call it, the Paycheck Protection Program. Lots changed. And so this one is really probably some of the most significant changes have recently happened. And so this is an opportunity for us just to catch everybody up. So I wanted to really let everybody introduce themselves. Chris, Adam, Alicia. So we'll start with you, Chris, just quick introduction.
Yes, I'm Chris Trump. I am an attorney at Edgerton McAfee, and I practice in the area of business lending, amongst others. And I also represent a lot of both banks and borrowers in transactions, commercial lending, business lending transactions. And some of those include SBA loans. And so we have been tracking as a firm PPP loans since their inception, and so this has been some of the best guidance, like timely guidance we've received so far. So looking forward to share that with you.
Adam Slack, president of Two Roads, and I'm going to consider myself a co-moderator today as well. Alicia Gates from our team is on. She's our resident expert of all things COVID/PPP when it comes to government stuff, and I asked her to come participate today. So you actually learned something. So I'll be here to potentially answer any questions, but we're mostly going to turn it over to Alicia and Chris, and I will also be leaving a little bit early. So Alicia?
Yeah, so I'm Alicia Gates. I've been with Two Roads now for several years. CPA and tax world and all things research related to COVID, PPP, EIDL loans. So I'm deep into reading all the regulations. So hopefully we're able to share some helpful knowledge today.
So we're going to, sort of the way that we're going to run this today, Adam and I will just sort of moderate questions. So feel free in the Q&A button at the bottom to please ask any questions that you may already have, or while they're talking. Chris and Alicia are going to kind of run things. Chris is going to go over what is new, and Alicia is going to provide, I think, some just technical input as well on some of those topics. And then as Adam and I maybe see a question or hear something that we feel like needs some clarification, we will jump in. But I'm going to turn it over to Chris.
Well, if you've been on any of these other seminars, you'll see I'm a little informal day. I'm actually off today, although I have had a couple of calls, but I am going very, very relaxed and dressed down today. But before we get started, I just want to provide a little bit of context. As you're aware, the PPP loan program was created by the CARES Act, and there has been quite a roller coaster ride. Initially it was a hastily put together program. We had a very short timeline to use proceeds, and without a lot of guidance along the way. The nice thing is this Flexibility Act really kind of takes a lot of the pressure off. We've all been trying to figure out how the SBA and the Department of Treasury are going to handle certain situations. On June 5th, Congress and President passed, and President Trump signed into law the Paycheck Protection Program Flexibility Act of 2020, and it really took a lot of pressure off, mainly because as a lot of people were very concerned about how am I going to get my loan forgiven, and so some changes that are in this act made it very much easier for that to be accomplished now, and take a lot of the kind of gamesmanship out of it that was kind of forced upon us with the prior law and rulemaking, or I should say absence of rulemaking. So now we've got the Flexibility Act, and then we have issued guidance underneath that, and so we have a pretty pretty clear picture of you know, how things change now, and it, you know, again, takes a lot of that out of it. So the plan is to kind of, I'm going to walk through the various changes that were enacted by the Flexibility Act. And as I do, Alicia's going to kind of jump in there. And if I miss a spot, I'll try and cue you. But if I miss a spot, Alicia's going to jump in and provide some kind of planning opportunities or implications, you know, of some of the changes, so that you can, you know, begin to make changes to how you accomplish your forgiveness application and administer your loan proceeds. So the first big thing that well, there's a couple of categories, we'll say. We'll just kind of group them in terms of the changes by the Flexibility Act. There were some changes to the actual loan repayment terms. There are also changes to kind of criteria for forgiveness. And those are the two kind of groupings. So I want to start with just the loan repayment terms, because they're not as kind of important, I think, from terms of planning perspective as much. So the first thing it did is, and think something to keep in mind here is kind of an odd situation, because we've got this, you know, the Flexibility Act was passed on June 5th. So loans that were, you know, closed after June 5th have a set of rules applied to them. The loans that were closed before June 5th generally have the same rules that are applicable to them as before, with, you know, in terms of the payment terms. However, you have the ability to kind of opt into these new payment terms if the borrower and the lender agree to do so. So some lenders, I don't think, are actually making any changes to the loans that were closed June 5th. They're really looking at this more of a prospective basis. The forgiveness terms will apply to everyone, because those terms aren't actually in your loan documentation. That's something that is just outside. There's you know, as you know, there's an application that's been submitted or created by the SBA. So generally speaking, those apply without you doing anything to it. However, you do have the ability, even on some of those loan forgiveness terms, to elect to use the prior rules, the rules prior to. So, for example, if you've done all your planning and based on this 8-week period, you know, you can forgiveness period. You know, you have 8 weeks to use the loan proceeds. Then you can still do that. You can still you know, elect to have that 8-week period apply. So, but unless you do, the new rules apply, to give you a little bit of a context there. So in terms of the loan payment terms, two big pieces of information that came from the Flexibility Act. Loans closed after June 5th will now automatically have a 5-year maturity date rather than a 2-year maturity date. So that'll stretch out the payments. If you got a pretty big significant sum, then that could be a pretty big nut every month, even with just a 2% interest rate. But now that it's 5 years, that'll reduce that principal and interest payment. The amortization will result in a lower payment every month. That I think will be very helpful. And then again, if you close prior to June 5th, you'd have to go to your lender and basically say, can we modify this to have a 5-year maturity date? The other change that happened was a change of the deferral period. So it was basically a flat 6 months under the prior CARES Act. And then with the Flexibility Act, it extended that date to, well, it's kind of contingent. Okay. If you apply for forgiveness, and get a decision back from the SBA within the 10-month period following your loan closing, or at the end of your cover period, your forgiveness period, which we'll talk about that in just a moment. Basically, your principal and interest payments begin to base the after the date by which on which the SBA remits its decision to the lender on your forgiveness. Okay, so whether they either tell you how much it's all totally forgiven, or some of it's totally forgiven, or none of it's being forgiven, that decision and the forgiveness amount that is associated, once that's given to the lender, at that point your payment will begin, and you'll have to look at this is for those loans that closed after June 5th. So you need to look at your loan documentation to see exactly how it's worded. I've had to do some language for various lenders to help them out with that. If you do not apply for forgiveness, then it's basically it starts within 10 months of the end of your covered period, that forgiveness period, the period in which you have to use all the loan proceeds to apply for forgiveness. And so the implication there is you probably are going to be expected to apply for forgiveness at least by the end of that 10-month period to be able to get your loan forgiven, although it's not quite clear yet whether that's the case. I believe that's probably what is expected at this point. Any thoughts on any of that, Alicia, before I?
Yeah, no, you've hit the nail on the head. You have 10 months from the end of your covered period to apply for the forgiveness. And then from that day, the lender has 60 days to get their decision over to the SBA. And then the SBA still has 90 days from that point in time to remit their decision. So it could be, over a year of deferral or more, depending on your situation. So then
on the payroll, so when it comes to forgiveness, now we'll shift to those categories and so of changes. There were several kind of significant changes to this. And they have different implications that the SBA has also issued, some guidance already. One of the most significant changes was before there was a requirement that at least 75% of the loan proceeds needed to be used to pay eligible payroll costs. As you probably have experienced, some of you probably have experienced, it's been a challenge for some folks to hit that 75% number, particularly during that eight-week period. That was initially the case. And so that number has now been reduced from 75% to 60%. So that allows you now to use up to 40% of the loan proceeds for eligible non-payroll costs. As a result, you have a lot more flexibility. So Alicia, you have some thoughts there. Maybe you can kind of talk through some of the issues we were working through before and now how that changes that.
Yeah, absolutely. So when you had the 8-week period, we tried to accelerate our expenses to get it inside that covered period. And then the 75%, we were doing some creative things with bonuses and some other methods. But now that it's 60%, you have a lot more flexibility with not trying to accelerate those payroll payments. And then you can also go back and potentially free up some funds if you were using them on questionable expenses. I don't want to say questionable, but maybe gray area expenses. You used $1,000 on a utility expense that was a trash bill. And maybe that's not really a utility. Well, because it's not linked to a bank account, as long as you can document, you had working capital back then, you could have paid that $1,000 bill with working capital at that time. You can take that $1,000 back and now apply it, put it back into your PPP funds, and then use those funds to pay for future payroll. And then, I think, Chris, you're going to talk more about the changes with the covered period, 8 and 24 weeks. But now that you can opt into 24 weeks, you can spread that out further. And really, it should be a lot easier to reach that 60% payroll threshold.
Yeah, so that was one of the big changes. Before you had 8 weeks to use the loan proceeds, and they tracked how you use that loan proceeds during that 8-week period. Now that has been shifted. We now have the ability to use the loan proceeds for over a 24-week period instead of 8 weeks. And as Alicia said, that does indeed provide a lot more flexibility on some of those things you were kind of questionable expenses that you were thinking about before. Do you have anything else to add to that, Alicia?
So, with the change of the 8-week and the 24 weeks, that also changes the max compensation calculation. Before it was $15,385 a person, but now they've changed that for owners and employees. So owners can have upwards to, I think the number is $20,833, and employees can have $46,154 max. So you have so much more flexibility just planning out how you want to spend your payroll.
Yeah, and that was a question when the Flexibility Act came out, as whether or not that 45 is 45, 154 or 46. I had written down 45. Would that apply to everyone? Because now, but basically, and based on the statute, you would think that would actually be the case. The language does not limit any amounts payable to partner-owned employees, but guidance came out from the SBA, which made it clear that they're looking at this from the spirit of the CARES Act and the Paycheck Protection Program. Is that workers get paid and there wouldn't be a windfall. They're concerned about a windfall to the owners. Basically, caused them to cap it at $20,833 per self-employed individual or any partner owner employees that are involved in the business. And so it's 2.5 divided by 12. That ratio is now what they're using. It comes out to $20,833 per person. I think that was one of the questions too that we got ahead of this was, how is that being handled? And so the 2.5 time, the ratio of 2.5 over 12 is where they use to get to the $28.33 per self-employed partner owner employees. The other thing I would just add with respect to the changes, there was one other change. There already was some safe harbors there for, if you remember, the CARES Act provides that there's a reduction in the amount that is forgiven based upon how many employees you have and retain during the time period in question here. So the idea is the Congress is trying to encourage you as an employer to pay people even for not working, keep them on the payroll. It was a way that they could get money to them instead of, your employees applying for unemployment. And so, of course, a condition to that is that you actually have employees to pay. And so they want to incentivize you by saying that your loans will be forgiven so long as you continue to maintain your employment levels and the salary that you pay your employees. Well, the SBA came out with I should say the CARES Act has it within it a cure provision. As long as you restore the employment levels and the payroll levels to a certain to the amount prior to COVID, basically by June 30th, then you would be able to essentially disregard any changes of employment in that time frame, and you would get the full forgiveness amount. Or a pro rata portion of it, depending on how many of those folks you rehired or the salary restoration that you did. So the Flexibility Act kind of codified that, and really the SBA has backtracked a little bit and has basically adopted the cure exceptions they had before. They replaced them with that in the Flexibility Act. First thing the Flexibility Act did is it now gives a cure date of December 31st, 2020. So now, instead of June 30th, you have until then, obviously with the pandemic kind of extending beyond June 30th and still in full force really right now, I would say. That is a helpful thing because a lot of folks are still going to have financial difficulties between now and December 31st. And so the hope is that by December 31st, you'll be able to fully restore, and then you will have no reduction in forgiveness. But I would say this too, the Flexibility Act kind of limits this safe harbor to really the number of employees. It's not extended to the amount you pay. If you remember, if you reduced the pay per employee below 25%, this safe harbor does not appear to apply to those folks, and the other safe harbor is basically gone at this point, as far as I can tell, except for those who've already applied for forgiveness. With the extension to December 31st, that gives you an opportunity to kind of adjust, I think, appropriately. So I don't think anyone's very disadvantaged by that. However, the cure exceptions that are still in place is if someone refuses to return to work, basically, you're unable to hire them if you document that you tried to and they didn't. If you are unable to hire similarly qualified folks to replace them, and this is probably the one that's most unlike anything we've had so far, is if you were unable to rehire them because your business activity is still at a low level, because at a lower level than pre-COVID, because your business is following guidance of CDC or OSHA. And so that's going to be kind of one of those certification scenarios where you're basically saying, hey, this is where I am, and that's the reason why. And if that's the case, then the SBA is not going to reduce the amount you're forgiven based on the fact you haven't cured those rehires yet. So so that's I think really kind of covers the gist of it. All the other things, a couple other thoughts there. If you remember when the first loan forgiveness application came out and guidance, there was the option to opt into an alternative payroll period, so that you're basically your payroll cost 28-week period began the first day of your first whole pay period within the 8-week time frame. Well, that's still in existence, but now it's for the 24-week, and so that stayed around. And the other thing too, that was some people had some question about when the Flexibility Act came out and they reduced it from 75-25 ratio on use of the loan proceeds for payroll costs. When they reduced it from 60 to 40, some folks were wondering whether there would be an opportunity to have partial forgiveness still. And they had made it clear that partial forgiveness is still going to be allowed. It's going to be kind of on a pro rata basis. To the extent you don't hit that 60% mark, you'll be penalized, but just on a pro rata basis. So anything else, Alicia, you want to cover in terms of planning and stuff that you think at this point?
Yeah. So Chris, you mentioned that the cure date was June 30th, and now it's December 31st. And it actually, just a small clarifying point, it is the date of your loan application forgiveness, or whatever's earlier, December 31st, or the date of your loan application.
Yes, I'm sorry. I have that written down here. I just didn't read it.
That's okay. That's okay. And there is a small safe harbor for the salary reduction. So if you do cure it by that, if the annual average salary does get cured by whatever that date is, there is a safe harbor for that. So you can't just cure it on the last day of the covered period. That's not going to work. Right. But it does have to get cured throughout that time period.
Yeah.
Yep. And so then a few other just kind of planning things. So, the salary reduction pitfall, we just have to be really careful with that, because you can actually apply for forgiveness before your covered period is up. So if it's the 8 weeks, you can apply. If you've used all the loan proceeds, you could apply before then, or 24 weeks, you've used it up in 18 weeks, you can apply for forgiveness. But if you do have a salary reduction that exceeds that 25%, whatever that additional amount is beyond 25%, say it's 30%, you have to extend that out for the entire covered period, even though you've applied beforehand. So say that reduction was maybe $50. If it was 8 weeks, then it would be a $400 reduction, 8 times 50. Or if it's the 24 weeks, it would be 50 times 24, or $1,200 in reduction. So be mindful of that as you're going into applying for forgiveness and curing those salaries.
So the idea there is to kind of is to time your application to a point where you've actually have satisfied the hit the safe harbor, basically.
Yes. Yep, exactly. Yep. And then we've already talked about it before, but with this salary changes, you can perhaps, before you were trying to squeeze it all into 8 weeks, if you maybe want to choose the 24-week period so that you can pay yourself more as an owner, the $20,833, or pay your employees up to that $46,000. I've lost it now, $46,154 per employee. But then if you have the salary reduction pitfall, you might want to choose the 8-week period versus the 24-week period, just to increase the amount of your forgiveness. So just think through those things, plan out your expenses, and your bookkeepers should be able to help you with that.
Well, we've been suggesting that folks kind of just fill it out at both ways, and see, for folks who the 8-week period could apply to, you have the option to either opt into the 8-week or stay. And it is actually a 24-week unless you opt into the 8, basically, is the way they're handling it now. So just run it both ways and see kind of how it works. If you're seeing a shortfall in the 24-week, on the 8-week basis, then then figure out how you need to change your numbers over the next few months to rectify that.
Mm-hmm.
One thing I wanted to jump in and ask, it's sort of has to do with this, but Adam, you guys have developed a tool, a spreadsheet, and maybe Alicia developed it for all I know, that kept track with all this stuff. And so a lot of stuff has changed, and so have you guys modified anything that we would want to get available to people again, or where does that stand?
There's a couple of guys in town that have developed a new spreadsheet. I think they asked not to be named, if I remember correctly. Alicia, do you remember being on that email thread? Didn't they say they just wanted to share it with the public?
They just wanted to share it.
Okay.
Yes.
Some really smart folks, and so they developed one that we do have that we can provide.
Okay. If you'll get it to me, I will get it to everybody that we've invited and has participated and stuff. So I want to make sure we did that.
You bet.
There were a couple of questions there, I guess.
Yeah, there's a few in here. We've got 3 so far. The first one says, I got my funds in my personal account on June 17th. Then I opened a business account on 6/26, and I transferred the money for tracking purposes. I'm self-employed, sole proprietor, LLC. Can I transfer the entire amount in one lump sum for salary, or do I have to split it up into smaller payments?
I'll just throw this out there, and Alicia can give a little more detail. But essentially, they're not tracking the actual dollars that you're using. Like the loan proceeds, they're not looking to see what you used that specific dollar that you got from the bank goes to. They're just looking at your expenses over the period. Do you have enough qualifying expenses over the covered period? And so, and therefore, ultimately, you're going to be capped at this amount per employee and per self-employed individual. So, Alicia, do you have anything else to say to that?
Yeah. So if you're a sole proprietor and you don't have any employees, they haven't really given us a lot of guidance. It kind of sounds like it's going to be automatically forgiven to whatever point that cap is for an owner. So, whether you take it in a small portion or a lump sum and it qualifies as your payroll, at this point in time, the guidance indicates they don't care.
The application does not distinguish between,
Right.
Yeah.
Okay, so the next one is in regards to the 75%, now 60%, payroll versus the other expenses. The question basically, is this a minimum or is it a cap? I'm a sole proprietor. The money given to me was only a couple months of pay. Can I use 100% of that money for payment to myself for lost revenue?
Yes. The answer is yes. As long as ultimately you're just subject to the cap. And so, so if your loan amount, if you, for some reason, gotten more than the two, at this point, when it's extended to 24 weeks, you really don't have any issues because you'll be able to use all of your loan proceeds in that amount, because the 2.5 is basically your loan amount.
Okay. The last one that we've got on here right now is the limit for EEs, employees, the 46,154, a gross amount, or does that include benefits?
That's just the cash compensation.
Right.
Yeah. But Alicia, is your understanding that 401k contributions would be included in that or not?
I don't believe it is. I think it's just the cash compensation portion.
That's my understanding too.
Mm-hmm.
Those are all the questions, folks. If you've got other questions, please throw them up. It's always great to go fast and be practical and get the information out, but we don't want to leave you if you've got things that you wanted to ask that we didn't get answered. So before
we really assumed a lot because we've covered so much already in prior seminars. So so if you got any questions about anything, feel free to ask them.
Hey, I've had this has bounced up a couple of times, and so I know we've covered this in the past, but just to reiterate, and I saw you guys had some notes, the FTE count, there are some qualifications. Alicia or Chris, you guys can handle this in terms of like employees that are no longer with you for different reasons that maybe you guys can talk about that again.
Yeah, I think we covered that just a few minutes ago with the
Oh, did I miss that?
there.
Sorry.
Yeah. But I would talk
Sorry.
about it in terms of FTE, which I think is important. What you're trying to distinguish there is the fact that the way you run that analysis is based on how many full-time equivalent employees you have. And so from that perspective, you have to look at how do you calculate what a full-time equivalent is. And so Alicia, do you want to talk a little bit about that?
Well, so the FTE definition provided by the U.S. Treasury is 40 hours equals 1 employee, and that is the max. You can't have somebody work 45 hours and be 1.2 employees. And then anything less than that 40 is 0.5 employees. So you are not trying to return names, you're just trying to return that head count, by the 1 or the 0.5.
Alicia, on the original application, there was the option to actually give like 0.7 or 0.8 based on the number of hours they actually work in comparison to 40 hours. Is that option still available as well?
Not that I've seen. No, it is now either the 1 or the 0.5. Yep. And the only rules that still apply that I have seen for any loans prior to June 5th is that you can opt into the 8-week period. All the other, the 60%, if you had a loan prior to June 5th, you still can use, you have automatically opted into the 60% rule for payroll.
Right. Good.
We've had some more questions come in. So are the funds able to retro pay us back, like for April, May, and June, or is it just for future salary if you're a sole proprietor? So I guess the question is, if I got it June 6th, can I use the funds for if I wasn't able to pay myself April, May, and or April and May, March, April, May, can I go back and pay? Can I catch myself up?
So a sole proprietor is capped at their 2.5 over 12 of their 2019 compensation. So it really doesn't matter when you received it. It's still that cap of the 2.5. So whether you didn't pay yourself months ago or it's future, it won't matter in the eyes of the SBA.
Okay.
I wanted to just clarify. Lisa, I just looked at the application just to make sure they still do allow you to basically take the number of hours per week an employee works by 40, and then you just round the nearest tenth. So you can get to 0.7, 0.8, because some folks would get disadvantaged significantly if you were limited to that. The simplified method is what you were talking about, and that is also still available.
So one of the questions, I'm going to bounce back and forth on some of these. So there was an ask to repeat the 401k, and this person said, I used our match portion when I've calculated what I am using each payroll. I'm also using net payroll amount for my calculation, is the first part of the question. Does that make sense? You guys, if it came to us as panelists on the chat, if you got the chat, you can look at it. It's the one question up. I guess the question is about the 401k, specifically using that as the benefits inside of the calculation, the payroll calculation.
I'll let you answer that one, Lisa.
I'm not sure I know the answer.
I'm not sure if I understand the question yet.
Yeah, I can't. I'm sorry, I can't see it on the Q&A, unfortunately. Or maybe it's in the chat.
It's on the chat. It's on the chat.
Oh, I see.
Gotcha.
Okay.
So would you repeat about the 401k? I used our match portion when I've calculated what I'm using each payroll. I'm also using net payroll amount for my calculation.
So you wanted to use the gross payroll amount for your calculation because it does include the employee's portion of payroll taxes,
okay.
but the compensation limitations are based on the cash limitation of the actual payroll. It should not be including the 401k.
The only exception that obviously would be self-employed individuals.
Correct.
That they're still limited to their max. So.
Yes.
Okay. And I guess that would apply to owner employees as well.
Mm-hmm.
And I think if we're going back to this question about calculating the percentage of FTE, same person's asking the question: if someone works 8 to 10 hours a week, are they half an FTE, or do we use the calculation of what whatever that comes out to, 0.25?
Yeah, whichever one that is beneficial to you. So, for example, if you've got a lot of people in the 0.5 to 1.0 kind of number, if you did the average hours per week divided by 40, if you have a bunch of folks in there, then you're going to want to prefer the more complicated. Just take every employee, take the number of hours a week they work, divide it by 40, and that gives you your number. If you got a whole lot of people in the 8 to 20 or 0 to 20 range, I guess, then you're probably going to use the simplified method and they all get a 0.5 FTE. Just run it both ways and see which works better.
I was on mute. So any more clarification on what is determined as need in relation to available working capital or other sources of liquidity? This was from our last one that we did. If there was kind of a lot of uproar about, oh my gosh, if we were, what are they going to do if they're going to do a test of liquidity and now we got to pay it all back? And so is there any more clarification on that?
I haven't seen anything additional on that yet. Have you, Alicia?
I have not. No additional guidance regarding that.
Okay. And so the from the past, do you mind just 90 seconds on what that means?
Yeah, so basically, if your loan is under $2 million, this is not something you need to think about or worry about. They basically said they're not going to review this. It's going to be assumed that you did not have adequate sources of liquidity. And then for folks over $2 million, we still don't know the criteria that they're going to utilize to determine. However, they have said that they will review each loan over $2 million to ensure that's you did not have adequate sources of liquidity. And again, I think they're probably delaying that because right now, like whenever we took out the loans, everyone was borrowing, we didn't know how long this pandemic was going to apply. And so from that perspective, people just didn't know what it was going to be like in November, and much less, in May and June. So what they basically said is when you apply for forgiveness, your loan will get reviewed if you're over $2 million, and they will look at that. And so from that perspective, when your timing when you apply for forgiveness, and now with a 24-week period and an extended time period to apply for forgiveness, it might be one of those things where you can time that so that it's more evident that you had this need for liquidity for the loan proceeds. It did not have an adequate source. However, again, we still don't know what the criteria they're going to use. Worst case scenario, you have to return the money back. They're not going to turn you over to other enforcement agencies, and they have just said they will not enforce, and they do not plan on turning you over to other enforcement folks like financial crimes and that kind of thing.
So question says, if you opt to use
thanks everybody.
Thanks for coming. If you opt to use the 24-week period, but you exceed it in 20 weeks, are you still liable to keep head counts through the 24 weeks, or can you base it on the 20 weeks?
So it's on the earlier of December 31st, 2020, or the date of your forgiveness application. So if you use it all up within 20 weeks and you apply at the end of that 20th week, that's the date that matters. But
you don't have to apply right then, though. You can apply in December if you want.
Yeah.
Okay.
Yeah. So I mean, ultimately, it's you have a lot of opportunity to kind of plan your when you apply for forgiveness. It really is the primary planning tool right now is just making sure you can max out your forgiveness based on when you apply that application.
Okay.
Submit that application.
Somebody asked, can you talk a little bit more about if you applied before and received the money before 6/5? This means you have to apply with the lender for the extended period? That's the question. Do you have to go back to the lender and apply for that? Or is that just for the moving
you need to
from
go
2 years
back to your
Yeah.
Well, you do need to go back to your lender and have a conversation with them.
Well, I think this question may be too nuanced. I think there's part of it where the payback period is moved to 5 years.
Yeah,
right,
that's the state. Yeah.
And the second part of it is just moving everything to December, 60%, all that stuff. I don't think you have to do anything about that, right? Okay.
No, you're not.
It's only the payback period that you have to go back to the lender and have a
The
conversation.
maturity date and the deferral period. If you're wanting to change those things from what you have currently, you need to go back to the lender.
Okay, got it. I thought that was right. And I'm not the expert, but I thought that was great.
There you go.
Next question is, if I take all the funds in a lump sum this week as salary for myself, $20,213, they're sole proprietor, and I received it on 6/17, can I start the forgiveness process, or do I have to wait 8 or 24 weeks? I think we kind of answered that. You can do the forgiveness anytime between now and December 31st, right? It doesn't.
Yeah, I think this is a clarification on the prior question where she was saying, do I need to make these payments over time or pay them? Can I just do it in a lump sum? And so, I mean, you know, I think you can at any point. I think if you're self-employed and that's all you got, I think you can do that at any point.
Okay. And then this is kind of a clarification on this 401k question. I don't know if you guys can see this. So can you kind of hit that? Basically, I'm confused as to why you could not count the portion of the company, the match of the employee's deduction to their 401k. I use the portion the company contributes to the plan because that's a payroll expense.
So my understanding is that it qualifies as a payroll. It is calculated as a payroll expense. So it goes towards that 60% calculation, but it does not go towards the cap for how much cash you can pay that employee. So you could pay them, you know, $46,000 plus their 401k.
Okay, that's probably the clarification.
That's the clarification.
Yeah, that makes sense. Okay. I think that's all of our questions. Do you guys have anything else that you want to add to this conversation for anybody?
I think
I think that's it for me. We've kind of hit on all of the strategy and all the big changes.
Great. And this was recorded. We'll be uploading this to YouTube and placing it on LinkedIn and Facebook and everything else. So and sending it out to everybody as well if they have any more, if they have anything else that they want to add. So you may have, I think, one more question. Oh no, they just said thank you. Okay. All right, sounds good. Thanks everybody, and I appreciate you guys being on.
Yeah, thank you guys.
All right, take care. Bye-bye.